Venture capital is ultimately just another asset class like bonds, listed equities, hedge funds, or private equity. But to be clear up front, for most venture capital investors, it's a bad asset class. It doesn't justify the risks investors take, and the illiquidity that investors have to endure is extremely long. So generally, median returns on VC funds in America, by way of example, have proved lower than simply investing funds on an index of listed equities, things like the NASDAQ or the Dow Jones. You'd be better off investing your money there than in VC funds most of the time. What's played out in the marketplace is that returns from venture capital aren't distributed uniformly like a bell curve. To the contrary, what you find is returns in venture capital follow what we call the power law curve. The distribution of returns isn't normal. It's heavily skewed towards a tiny percentage of firms. And these winners capture a large percentage of the returns or the profits in the industry. So if you're an institutional investor, your likelihood of investment success in VC is really small. Now, what amplifies this phenomena even more is something called positive signaling. The most successful VC firms develop a reputation for backing successful startup companies. And that positive brand signaling attracts more of the best entrepreneurs to them. And the same process with regards to ability to attract capital takes place. So most VC firms don't generate the returns they're targeting. It's only a few players out of many that actually achieve outsized returns. And VC investing is a zero-sum game. Many investors can buy shares, for instance, in a listed company. In VC, one lead investor or maybe two investors get a shot at the initial investment opportunity, and the others are locked out till subsequent rounds. Once investment round one is completed, it's gone forever. There will never be another first financing round for Mr. Mac Learning again. Whatever return is generated from the first fundraising round will accrue to a very small group of investors. Obviously, there'll be subsequent funding rounds for Mr. Mac, but the valuation will have gone up by then. So the return for subsequent investors will make them trail what the original investors get. Investing in VC is also restricted to what we call accredited investors, generally institutional investors and high net worth individuals. That's because accredited investors are presumed to be more sophisticated. They're able to understand the risks involved. They're better able to weather the losses. In reality, venture capital is a very small asset class. It's a very small asset class. It represents a tiny amount of capital at work in the broader financial system, but because of its impact, venture capital punches well above its weight. Apple, Facebook, Microsoft, Amazon, Google. These are today some of the largest companies in the world by market capitalization. All of them were originally backed by venture capital.